Good afternoon. I'm Chris Chelius, part of the Option Ranger Development Group. For anyone who missed previous webinars, give us a call at 800-519-9085 and we can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you are a guest but not part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure. Please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our long straddle and short straddle, when to use and how to calculate webinar. Mr. Mueller?
Thank you, Chris, for the nice introduction. And let's go ahead and begin our presentation today. We are going to be doing the long and straddle and short straddle presentation. And let's go ahead and review the basics and get right to it. First of all, to be sure, there are multiple types of option calculators. Today we are going to be working on a master combinations calculator, which covers all the markets. However, the learning module for the long and short straddles is within the future spread calculator or the stock spread calculator, depending on which type of long and short straddles you are doing. Now let's go ahead and have a look at a couple of the markets that we will be following. And the first one is going to be the copper market, as you can see in the market section. We have all of the markets covered on a drop-down menu, and if you click on copper in this particular case, you will be brought to the copper contract specs page, in which you're going to see the specifications about the contract and the categories that were developed in conjunction with the Dow Jones editorial and writing team of what we call the what to watch area. In this particular case, as you can see in looking at copper, there are many factors in play that are generally considered when making such a decision. So we are going to examine today how two completely opposite outlooks about volatility in the copper market can be reviewed and how an individual trader can take advantage of different opinions. Now let's have a look at the two strategies. Both of the strategies that we are reviewing today involve strategies that do not have a specific outlook as to direction. So a long straddle and a short straddle, which we will be looking at today, and then subsequently the long strangle and the short strangle, which are similar trades we will be examining in a couple of days, they all have no directional outlook and are strictly designed based on volatility expectations. And we are going to look at this as counterparty. So on one party, although which doesn't know direction, however, they feel there's going to be increasing volatility in the market. They think volatility is going to go up, the market's going to make a big move in one direction or another, but without any opinion as to which direction it will be. So this is strictly a volatility trade, and in the case of a long straddle, as you can see, it is a trade which anticipates rising volatility, and the counterpart of the trade, as you can see here, which is the short straddle, is a trade which anticipates no rise in volatility, and in fact it anticipates diminishing volatility. If you look at the two positions just at a glance, as you see, they are total opposites of each other. And in fact, when you look very briefly, in one trade, you are looking for the market either to go up or down past this tight area where the cost has to be overcome. And in the case of short straddle, the market is needed to stay within the area. So you have two counterparties that have no idea about direction but share one thing in common, and that is the opposite. They have opposite views of whether the market is going to make big moves in one direction or the other, and the other that it is not going to make big moves in one or the other direction or the other as defined by volatility. So as you know, once we go into the strategy gallery, we click on a particular strategy and we are going to see the particulars of that trade. Here, in the case of a long in the case of a long straddle, I clicked on long strangle by mistake. Again, we are looking at the particulars. Undecided direction, rising volatility, and when we look at the particulars of that trade, as you can see here, there is an expectation that the market in this particular scenario is going to break out, that it's going to break out in one direction or the other. And in this particular case, as you can see, if this is the strike price at which the straddle is written, there is a premium that is paid, which is in this range, and in order for the trade to become profitable, it has to break out beyond that range, either on a drop or on a rally, and overcome the cost of the trade. So as you look here, when we say when to use, we have, again, an expectation of rising volatility. In order to achieve a profit, the market has to move sharply in either direction, as we indicated, and we're going to show which levels have to be exceeded by the move. The loss in this particular case is limited. So it is limited to the premium that is paid and the transaction costs of the trade, and the maximum that can be lost is that amount, the premium plus transaction costs, and not more. The profit potential is unlimited once the market exceeds that zone of premium and costs and moves further in either direction. So this person is looking for an explosive move, and for those of you that want to see some of our previous programming, as you can see here, we already have a previous program on long strangles and long straddles that goes into significant examples, along with a further detail of the trade and the narrative, which discusses the break-even points. By the way, in order to see further such examples, you can go to our reference material section and go to demo videos, which have been newly recategorized by strategies, and you would find these in the spread examples. So again, we see now the case of a long straddle. Let's go ahead now and look at the complete opposite view. So on this side, we have somebody who's looking for an explosive move and is taking a limited risk. And we're also going to look at the short straddle, which has the complete opposite outlook. And let's have a look at it again. Here's a short straddle. Let me go ahead and click on it. And here we have the particulars of this trade, which is really the opposite and counterparty of a long straddle. In this particular case, a person is willing to take a limited rate of return or have a limited profit potential in exchange for anticipating that the market is going to be quiet and actually stay within the range. So this is the counterparty that thinks the market will stay in this range to the long straddler who believes that the market is going to break out of that range. So these two totally different opinions, and the profit scenario here is different. The person thinks the market will be flat and not move radically in either direction. The profit and risk scenario is also flipped. In this case, the profits are limited to the premium collected from the writing of the option minus the transaction costs of those options. So there's a limited profit, but on a huge explosive move, either up or down, the loss can be unlimited. The loss can be unlimited because the market can break out. So in either direction, overcoming the amount of premium collected. And again, whereas the long straddle is damaged by the passage of time without an explosive move, the short straddle, again, the total opposite, benefits from time motion. So if the market stays flat, the longer it stays flat, the more time decay affects the options that were sold, and the more profitable the short straddle becomes. So now we've got the two counterparties to a trade, and let's see if we can actually look at their points of view. Let's see if we can actually look at their points of view and come up with some different trades and put a scenario to their opinion. So let's see, and we've already, for purposes of convenience and illustration, we've already illustrated a couple of markets as we have before. So let's look first at the copper market, and let's look at a long and a short strangle. As we indicated previously, in the case of a long straddle, in case of a long straddle, not strangle, this is a straddle, so we'll make the correction. In the case of a long straddle, we select the copper market. You get all the specs. It's 25,000 pounds in the contract. Those are the tick values. And as you recall, we can click on the contract specs for copper. And we are going to go, in this case, to the copper and to the various factors that affect the copper market. Then we input the output rows. We input the type of trade. And once the trade is selected, when you select the long strangle in the dialog box, the entire input screen is adjusted so that the specifics of the trade are input as a default. So because a long strangle consists of buying a call and buying a put, those two inputs appear. So we just input the particulars of one buying, one call, buying, one put. And classically, this is done in a 1-to-1 ratio. So you could do 1 by 1, 2 by 2, 5 by 5, and so on. And as is the particular of a straddle, they are done at the same strike price. So straddle implies that you are, in this particular case, if you're long, you are buying a call and you're buying a put at the same strike price. And we've already input the premium amounts is 9.5 and 15, so we collected a little bit more on the put in this particular scenario. So you would generally assume that that means that a person is moderately more bullish, and you can try different strike prices and different premium amounts in order to be consistent with the particulars of where you think the market is going to, in this particular case, where it's going to break out of a range. So by spending more on the put, although we're looking, this trade is looking for a breakout in either direction, perhaps it's more anticipatory of a drop, and you can model out different strike prices and different premiums to find your own sweet spot. So here in the dialog box, we have the particulars of the trade again with the premiums, and of course we've done what's very important. We've translated the premium points into dollars and cents. And that's very important again because of the tick values on this contract. We're looking at $250, as we indicated, $250 a penny. So the calculator basically does the math so we can quickly get to the bottom line of dollars and cents. In this particular case, the person who purchases the straddle. This person is looking for a big move one way or the other, spends $61.25 in premium. Of course, when you do business, you have to count the transaction costs, which are defaulted in here. So the total cost for the long straddle in this scenario is $62.35. And as you will know, in any strategy that is long premium, just net long premium, the maximum loss and the initial debit are identical, because the buyer of premium cannot lose more than the premium and the fees associated with the purchase. So in this case, buying a call, buying a put, the risk is limited to the costs and premiums of those transactions. For purposes of calculating break-even, this has been translated into premium. So somebody who purchases these positions has to overcome 24.94 points in premium. Let's call it 25. So in monitoring this trade from day to day, if somebody sees that this particular trade is up 10 cents, let's say from 25 to 35, then 10 cents times 250, or 10 cents times 250, which is one options unit, is 2,500. And of course, if it's 10 cents down, it's a loss of 2,500. So you keep monitoring the premium at all times. From the standpoint of making a longer-term plan on this trade, we're also showing the break-even on the futures itself intrinsically. And again, because this is a two-sided trade, the person's looking for a breakout in either direction, whether it's the downside or the upside. We have the break-even on futures intrinsically at expiration. And again, on a drop, we're looking at 275.06. On a rally, we're looking at 324.94. And the premium, as you can see, is both on both sides because it was the same that was paid. And now let's look at the particulars of the trade. As you can see, if the market stays flat and is stuck in the middle, and nobody offsets anything and nobody offsets any positions, right in the middle, if it expires right at the strike at 300, which is the strike that is bought and sold, that is where the maximum loss is incurred intrinsically. If the market, to any extent, makes a move in any direction past that one, I won't call it the sweet spot, I would call it the worst spot, if you will, for the person who's buying this straddle, the bigger the move, as you can see, the losses start diminishing. If there's a big move in either direction, on a small move, they diminish less. On a big move, they diminish less. And then, intrinsically, once they break past the break-even, on the call side, that happens somewhere a tad below 325 on the contract, as you can see here. So we're looking at a rally somewhere ideally above 325 by as much as possible, as you can see, because the numbers do increase when you get to 350 and beyond. And likewise, if not a big move to the upside, then conversely a big move to the downside. Let's say, and as you can see, once the premium that is paid is overcome, every 10-cent move is a further gain of $2,500, and every 1 cent move is a gain of $250. Because this trade is damaged by time erosion, it is very important that if the market lingers in this range, let's say between 310 and let's say 290, 280, whatever the range may be, and the appearance of rising volatility is no longer there, then this person or the person who speculated on rising volatility should monitor those premiums at all time and look for a place to exit that market. In the particulars of this particular trade, you have to bear in mind that you have to believe that the market is going to make a certain move and that the move is going to be large enough. And let's have a look now very briefly at a chart to see how these two people might have differences of opinion on the market. So let's have a look at a long-term copper chart. This is a weekly chart. And as you can see here, this difference of opinion that we're seeing is this person thinks, you know what, I think that this market could get somewhere up here. it's going to really fall apart and get somewhere down here, or make a larger drop, then that person would buy this strangle if they think it's going to move big in this direction or to the downside. On the other hand, if they think that it's going to trade in a narrow band over here, the person would not want to do a long straddle, and this is where the difference of opinion comes in. We'll show it momentarily. So one interpretation is, and it's difference of opinion that makes a horse race. One person looks at this chart and says, for whatever reasons, I think this market is showing signs of breaking out to the upside or the downside. I'm going to buy a long straddle. If they, with rising volatility, so I think it's going to break out with rising volatility. Another person might look at this same chart and say, you know, I think this market is just going to go back into this range. So they've got a completely opposite opinion and think that the market is going to stay within that range. Well, that person indeed would do an opposite trade. So that person, instead of doing a long straddle, would do the exact opposite, and that would be a short straddle. And you see that the composition is the same, except instead of buying a copper call and selling and buying a copper put, the person who shorts the trade does the exact opposite. They sell the same call and they sell the same put. In effect, this is the mirror image, or if you will, perhaps for illustration purposes, the counterparty with the opposing view. So now, as you recall, we looked at the short straddle, and now that we have it selected here, with the particulars, again, we have whether you list short strangle or short straddle, it'll work. Although this particular trade is a short straddle because they're at the same strike. Again, all the particulars come up with the strike prices and the premium examples. And really, because the inputs and the math are the same on a short strangle and a short straddle, by inputting the same strike price in both cases, the number still comes out accurate. So as you can see again, because we said short, in this case, instead of showing buying a call and buying a put, the dialog boxes and the defaults are set to selling a call and selling a put. The strike prices, again, are input. The premiums are the same, so that this is really intended to be an objective view of the opposing trades. And as you can see here, almost everything is the flip opposite of the other. So in this particular case, the person who sold this call and sold this put, instead of spending $23.75 and spending $37.50, is collecting the $23.75 and $37.50 for a total credit of $61.25. Again, we're translating the premium into dollars and cents to get a bottom line picture. We subtract the transaction costs, so we have a clear picture of exactly what the potential costs and rewards are. And in this particular trade begins not with a debit, but with a credit of $6,015. When you see that a trade begins with a credit rather than a debit, it's usually a fair assumption to make that this is a margin trade because you're collecting premium. So let's go ahead, and as you can see now, although the credit is $6,015, this person thinks the market's going to stay in a range, and however, on their risk scenario, if the market breaks out of the parameters and break-evens of this trade, the losses are going to be $12.50 per tick move above the break-even of 324.06 and or below at 275.94. The numbers must look very similar to the others, because the places where the unlimited profits start to run for the long straddle is the place where the margin losses and the tick-for-tick losses on the futures begin on the short straddle. So in this particular scenario, the sweet spot is in the middle instead of on the fringes, because this person is betting on a sweet spot within a certain standard deviation of this market and is not anticipating the market to make significant moves beyond there, so the expectation is one of diminishing volatility. As you can see in this scenario, As long as the market stays intrinsically above the low break-even point and below the high break-even point, there's an area of profitability. And now, again, because everything is so clearly balanced, the maximum gain is at the strike price. So in this scenario, the place where the long straddle loses the most money is the place where the short straddle potentially can make the most money. As market moves in either direction, the smaller the move, the better. The larger the move, excuse me, the worse. So we are looking at two counterparties, both of which have no clue on direction, taking totally opposite sides of the trade. One side looking for rising volatility, and one side looking for diminishing volatility. Do we have any questions at this point?
Yeah, there's one question, Mr. Mueller. When picking these strategies, do you consider, or does one consider, the expiration months of the options? And how does that play into whether you pick your decision-making process into picking one of the strategies?
And that is an excellent question. You always have to define an option as to a month. So in this particular case, as you can see, the month that is used, and it's listed in the tab, is July copper. When deciding which trade to do, in this particular case, more than anything, a person has to have a volatility outlook that is within the specified time frame. So that the two counterparties in this trade would have a very different outlook. For example, the writer of an option, so the person who does the short straddle, which we're looking at now, would have to decide what is the time frame of greatest time decay. So under ordinary circumstances, many people say that that would be 30 to 60 days prior to expiration. So as a rule of thumb, some people might say, I'm going to go ahead and do a short straddle, but I'll do it during the period of greatest time erosion. A person who does the long straddle, by the same token, would have to have an outlook of when is a major event likely to occur, and would have to make an assessment that volatility is going to go up. If the expectation is that the volatility is going to go up soon because there's some geopolitical event that is brewing or that this person is anticipating, or there's some major report that's coming out that the market is not sufficiently considering as an explosive factor in the market, then somebody who does a long straddle might do a shorter dated expiration because their outlook is for short-term significant rising volatility. In certain markets, if the premiums are low enough, somebody can put on a longer-term long straddle and have more time for the trade to develop. And again, assuming volatility is very low, then time erosion may not hit that trade, and a positive change over a longer term can work. That's why one needs to look at historic volatility in the market, so they can come up with a scenario of whether the implied volatility is too high or too low. And as we know, these trades aren't entirely predicated on a volatility outlook. So certainly, as you will recall, on the short straddle, on the long straddle, the volatility factor is the only known or opinion that we have. We have no directional opinion. Again, what I would look is compare historical volatility to current implied volatility, and if a person thinks that the market is factoring in extremely low volatility, then you go long volatility. You might do a long straddle. If you think the market is extraordinarily too volatile, or too much volatility has been implied, if you will, into the prices, then that person would sell volatility. So just like in direction, if a market is low, you want to buy it, and if it's high, you want to sell it, assuming we know what those levels are. Likewise with volatility. If volatility is too low, in one's opinion, they can buy volatility, do a long volatility trade, like a long straddle. And if they're short volatility, they can sell volatility. So if volatility is too high, you sell it, just like you would sell a high direction. And if volatility is low, you buy it, just like you would buy low directionally as well. The other thing that I would look at as a factor in these markets in terms of selecting the particular month when the trade occurs, and let's go here again, is the liquidity in the month. So in this particular case, and you get those liquidity figures in the platform that we provide you. So when you look up option prices, so you get the real-time option prices and quotes and premiums, you can actually look at the different months, look at which months have the greatest liquidity in option trading, so that you can hope for better execution, and also make sure that the strike price in which you are transacting is a strike price in which there's a reasonable amount of volume and open interest for ease of entry and exit. If the market is not sufficiently liquid, especially because you're doing two legs, you might have to really consider whether or not you want to do volatility-only trades in those markets because of execution issues. Is there any other question?
No, not at this time. Thank you.
Okay, thank you very much. Now let's go ahead and do a very quick example. We're going to do a stock example now. We're going to look at the stock, and again, we're going to look at a short in this particular case. Let's go ahead and look at a long straddle first. Again, when the call and the put, when the calls are at the same strike or the puts are at the same strike, when the calls and puts are at the same strike, it's a straddle. So in this particular case, we're looking on Amazon, which is trading around 355. And let me look at the month here. So we're looking at, okay, we're going to get the month on that. So again, we're looking at a cost of 10, and this person is betting that Amazon is going to break out one way or the other with rising volatility. The strike price is where the market is, so they're both at the market, a call and a put. As you can see, it's fairly efficiently priced because the prices are fairly close to each other. So now we can see what this person spends on the trade. Again, the boxes, the input boxes are set up, so once you select, in this case, long straddle or long strangle, you buy a call, you buy a put, input your strike price and premium, and we have the way to do it listed, and then we go straight to the trade. In this case, the net outlay for this speculation that the market's going to break big one way or the other, in this particular stock in Amazon, the person would be spending $47.50 plus, let's say, a transaction costs. In here would be a net debit of $47.70, and as we indicated before, when you are long premium only, when you write premium and you have no naked options or no naked futures or naked contract, your maximum risk is limited to the premium and transaction costs spent. So in this case here again, the break-even point is 47.7, which is 47.7 times 100, because it's 100 shares, is 47.70. And as you can see, whether the market goes up a lot or down a lot, what this transaction has to achieve is a sale that collects more than 47.7 in premium that was spent. And again, to look at the intrinsic value on the stock at expiration intrinsically, when all the premium and time value is gone, would have to be below 307.30 or above 402.70. The person putting on this trade really needs a significant breakout in one direction or the other. Again, the risk is limited to the cost of the transaction, premium plus fees, and the maximum profit is unlimited on the upside on a big breakdown and certainly on the downside on a big drop. Hypothetically speaking, the profit is limited on a drop insofar as the stock can't go under zero, but as you will see, the moves can be pretty significant. And let's have a look here. As we said before, when you're a long premium, you need to overcome those costs. So the 355, where the straddle is placed, where the long straddle is placed, as you can see, is the level at which the maximum loss can occur, because the max time erosion on both options would occur with no intrinsic value. The extent to which the market moves in one direction or the other begins to mitigate that maximum loss as either the call or the put begin to go in the money. The bitter spot, if you will, the not so good spot, is close to the market where we are, because this person was betting on significantly rising volatility, and if they don't, then they're wrong, and the market's flat, then they were wrong, and that's how they get to lose. If they were correct, and the market breaks out significantly to the upside, as you can see on a pretty sizable move, the numbers increase, and just as in the stock, for every dollar that goes up, the option goes up 100 because it's 100 shares. So again, the upside, as you can see, the bigger the move, the bigger the breakout, the larger the gains. And likewise on the drop, because it's betting on big rising volatility, the bigger the drop, the bigger the gain. To be sure, there's no requirement that these positions be offset together. So although the trade is currently being described as a spread where both sides gain or lose money together, you should be aware that these positions can be offset one at a time. So for example, if the market breaks out in one direction, perhaps one can offset one side and still offset the other before it's worthless. Or for the real directional and swing trading geniuses, they can leg out of this trade, perhaps in a hugely volatile market. If it runs up first, they can offset the call, they can hold on to the put, and arguably, if the market breaks back down in the other direction, then they can leg out of the two sides. So one of the things to bear in mind on these spreads is that although the calculations are done on the trade as a single trade, as a spread, the individual trader has the flexibility to lift one leg at a time, to add a leg, to move a leg, to adjust the trades, and that's why the follow-up of the spread strategies is so important, because you want to be able to navigate your position based on new information and new inputs as the markets require. Now if we go back again to this position and go to somebody that has the diametrically opposed view. Now we have this buyer of an Amazon straddle is looking for a big move in either direction, but as Mark Twain wisely said, it's difference of opinion that makes the horse race. On the other side, you can have somebody that has a completely opposite view, who instead of being long volatility, looking for a huge move one way or the other, in Amazon, actually thinks that the market's going to be tame and is not going to go anywhere, has the completely opposite view, makes the totally opposite speculation, if you will, and instead of buying a call and buying a put, which is a long straddle, they sell a call and sell a put at the same strikes, but in this particular scenario, instead of spending this money on those options, they are collecting it. And as you and certainly you can scroll back and forth between the two trades, you can easily see how these columns change accordingly. So you see how the buyer is spending this money at the same strikes, the same levels, whereas the writer is doing the exact opposite. And having opposite expectations, their profit and loss grid, as you would imagine, looks totally different. The break-even on this position, for example, is 47.3. So having collected this money minus costs, they want to collect that premium. The sweet spot for the trade is near the strike price. Actually, at the strike price is the sweetest spot of all, if you will, because that's where the maximum was collected. Hold on a second. Let's go to 355. And that's where at expiration there'll be no time value left in the two options, and the maximum would be kept. Any extent to which the market is outside of that particular strike price where the straddle was done, as you can see on the small drop, on the small rally, the profits decrease as the size of the move increases, which is only fair because this person was betting on a flat market. And the cushion that they have from selling that call and put disappears once they get to their lower or higher break even. So now they have a sweet spot that's close to the strike and a danger of loss and risk if the market breaks out in either direction. So again, a person has an expectation of diminishing or small volatility is going to make money if they're right and the market is flat, but if the market runs up or runs down significantly, their outlook on volatility was wrong, as you can see, and then losses can be incurred. Again, whether or not somebody will sit around and incur these losses or implement other strategies to offset and salvage is a function of monitoring the premium in the trade at all times and updating one's outlook on volatility and direction as they go. So again, bearing in mind again that when you sell options, in this particular case, it's being short premium. All money is initially collected and there's a margin of error. Once the break-even levels are exceeded either on premium or on the underlying contract, the loss is tick for tick. So for every dollar above 402.30 in this particular case, there would be a loss here of $100, which is $1 times 100 shares, which is graphically represented on both a big rally as well as a big drop in this particular stock. The final example, and I'll make it very quick, is on T-bonds. And again, here we have a complete difference of opinion. As you can see. One person is long volatility. They're buying premium. They think the market's going to break out significantly, one way or the other. So interest rates are either going to fly or tank relative to current volatility on the buying scenario. And as we indicated, short premium on a writing scenario, the expectation is that the market is going to be tame and stay within a certain trading range. So let's go ahead and look very quickly, and you can look at these examples later as well, both on a rebroadcast of this program and if you set it up in your own tab. Well, we do the long straddle in this particular scenario, and the long straddle will give you the same output because it's really the same math. Again, you are buying a call and a put at the same strike price. That's the definition of a straddle. The premium is input. We see what the contract specs are, the strike examples and premium examples. Person who's a long straddle spends money. They spend premium. In this case, it's translated to $3,000. Transaction cost is $31.10. Being long premium, again, with no margin, means that the risk is limited and predefined in this case, again, to the cost of the transaction, which is the premium spent and the transaction costs spent. So the risk is limited in that scenario, and what requires for this trade to succeed is a significant move and significant rising volatility in either direction. We have our low break-even point and high break-even point intrinsically, and our premium break-even points as well for monitoring the trade from day to day. The sweet spot for somebody who's buying again is, as you can see, to move away and to be shifting as far away from the strike price of the straddle and break out in either direction. In this particular scenario, as we can see, the strike price where the options are purchased is the place of biggest and maximum loss. You really have to be precisely there to lose the maximum. As you can see, once the market moves in either direction, the losses become less and less because one of those options, the call or put on any sort of move, are somewhat in the money. And again, here as you can see, the bigger the move to the upside, the bigger move to the downside, the better the gain. The important thing for somebody who's going to bet on rising volatility is that if they don't get it, they should not incur the maximum risk. They should have a strict discipline to monitor the position and to offset either as at a predetermined premium or at a predetermined alert on futures prices, and of course that requires a lot of thinking in detail. I do want to point out that the reason some people do these strategies is if they think interest rates are going to go really ballistic, whether it's one way or the other, the tick values can be very strong and the moves can be very significant. On the opposite side, now we had a person who's expecting rising volatility in interest rates. The counterparty to this trade, somebody is expecting diminishing volatility and they're going to be short. Instead of buying the call and put at 133, they sell it, they write it. Instead of spending money, they collect money. And you can look at these trades side by side either by clicking on them, or you can look at them side by printing them, or emailing them to view. And now as you can see, the person who sells these options, instead of paying $1,500 for the call and $1,500 for the put, now are collecting $1,500 for the call and $1,500 for the put. As you can see, these can literally be two opposite sides of the same trade. This person is looking for the market to be quiet and tame. They start out with a credit of $2,890 after cost, which is the maximum that they can make. The maximum that a person can make when they're collecting premium is the premium that they've collected minus the transaction cost, and that's it. On the other hand, this is a margin trade. So every tick above or below the break-even, either intrinsically on the contract or on the premium, is a loss of $31.25 per tick, and what we're really looking at is $1,000 per basis. Let's have a look here, as you can see under the options unit. And now the writer or seller of the straddle has a scenario that is exactly the opposite for the one of the buyer. So you really see now how counterparties betting on different opinions have entirely different outlooks. In this case, the most that can be made is at the 133, which is at the strike price that the straddle is sold. And if the market's right at 133, the call's going to be worth nothing intrinsically. The put's worth nothing intrinsically in theory, so that would be the precision level where this trade at expiration could make the maximum gain. That's very difficult and unlikely because the market doesn't just sit in a particular spot, or certainly not at expiration. But again, the closer the market is to the strike price where there's a short straddle, the closer it is to that level, the bigger the gains on the trade, and the more of that initial premium collected can be kept by the seller of the straddle. Again, in total counterpoint and with an opposite objective from the buyer of the straddle, if this market breaks out big in either direction, then the one who is short the straddle begins to incur losses, and in this case, because there are naked options on both sides, the margin losses are unlimited and pretty significant. So a person in this particular scenario doesn't just have to have an outlook of diminishing volatility, but they have to have a reasonable risk tolerance because this is a margin trade and has all of the margin risk. Just because they're options doesn't mean they have less risk. They're short option, and short options are a margin trade. So these are, again, two counterparties. We feel it's very important for people in looking at trades sometimes to look at them independently and sometimes to understand them within the context of who would be the two parties to a transaction, how are their opinions opposite one another, and how does the calculator and our spreadsheets provide an illustration of how these different views can be considered and matched against each other when selecting a trade. Do you have any other further questions?
No more questions, Mr. Mueller.
Okay, well, I want to thank everybody for attending. Please be sure to check in on our site. We are updating our strategy gallery and our demo videos all the time. And as before, we do appreciate your feedback. If you have any comments, any suggestions, we'll be happy to act on them as quickly as we can. Have a great afternoon. I look forward to our Thursday program, which is going to be a related program. It's going to be long and short strangles, very related to long and short straddles, the difference being that instead of the buys or rights being at the same strike price, they are at different strike prices. And we're going to see how that impacts the spreadsheets and the outlook of the speculators. Have a great afternoon and look forward to our next get-together.